All right, hold on. I'm not recording yet. All right, it looks like we're going now. Good morning and welcome to WeSERVE Community Development Center, Corporation, where we partner with various entities across the nation to provide classes, workshops, reading materials, distribute food and other services that support our community. In 2023, we were blessed to be able to receive a grant from the Virginia Health and Disparities Entity, which will allow us to provide programs that will mitigate the lasting effects of COVID-19. It allows for us to partner with faith-based and other entities, again, to provide needed and critical services and resources to those that are most definitely in need. WeCARE, the program that we have started, offer support in the following areas: food distribution, emergency shelter and disconnection prevention, employment support and resume readiness, behavioral and mental health wellness. And we're doing all of this so that we can provoke change in our communities. Our motto or mission at WeServe is to serve families, meet needs, and build communities. Serve families, meet needs, and build communities. And so we're doing this, and a part of this building up of our community is to upgrade our knowledge and our understanding of the importance of being financially literate. Financial literacy is something that's not pushed in areas, communities of color, and it's imperative for us to be able to get out of the places we're at and to move into where God is destined and ordained for us to be. We have to know how to handle our money. And so part of the workshops that we've committed to doing in our financial literacy, you'll see on our screen, we've had a retirement readiness workshop. We talked about the 5 pillars of financial strength. You can find those things on our Facebook page. You also be able to find those previous workshops on our YouTube channel. You can subscribe to our YouTube channel and you'll be able to replay these trainings. And so today we're talking about life insurance 101. What's amazing that we're in 2023 and people still do not have life insurance today. When our family members and our loved ones pass away, we have to scramble. We have to do GoFundMe initiatives to try to help raise funds to bury them, when it doesn't take much to begin or start a life insurance policy or package that will not only be a blessing to take care of you once you pass away, but also to leave something a little bit behind for those that will be mourning your passing and mourning your loss. And so we have partnered with Will Way Community Enrichment Corporation to assist us with providing financial literacy workshops and training and seminars that will help build up our community. And so this morning, I want to welcome you all to, you've seen him before if you've tuned in, to Brother Renix Graham, Mr. Renix Graham. He's going to take us further in our workshop on today.
Yes, sir. Thank you, Mr. McCowan. I greatly appreciate this opportunity today to talk about the value of life insurance on today, discussing on Life Insurance 101, the importance of life insurance. And just to piggyback on what Mr. McCowan was saying, is the true purpose of life insurance is to protect your family, is to make sure your family is covered. It's not about you, it's not covering you and yourself, but it's to make sure your loved ones are protected. As you can see on the picture here, you can see the image of the umbrella covering other family members. That serves as protection over your loved ones, over your spouse, over your son, your daughter, your niece, your nephew, whomever you feel is important in your life. You don't want them to have to grieve the double grief. You don't want them to have to suffer double the grief, except just grieving one time, which is the absence of your loss, but not having to grieve over funds, not having enough to bury you or to memorialize you. And so today we're going to cover Life Insurance 101 under financial literacy. And we're going to dive right on in. So meet your facilitator, yours truly. I am, of course, Renix Graham, the facilitator for today, and just a few bullet points of who I am. I am a business entrepreneur. I serve in different capacities in the entrepreneurial field. I serve as the senior field manager in the financial service industry. I have 8 years going on 9 years of experience in the financial field as a financial strategist. And I am also multi-state licensed in other various states throughout the country with healthcare insurance, life insurance, retirement accounts that covers IRAs, 403Bs, 457s, and so much more. So why life insurance? What is so important about life insurance? And it is because your family is worth it, which I believe they should be worth it. And so with these different topics and points you see up front on the screen, you don't want your family having to deal with debt. It's for tax saving purposes, to supplement retirement goals, for peace of mind, to help achieve long-term goals, to creating a source of savings, and to taking care of loved ones, is to make sure that it is important that your family is taken care of. And there's so many various reasons to having life insurance. And here we have 5 most common myths about life insurance. Some will say life insurance is expensive, contingent upon your age, how old you are. The sooner you get life insurance, of course, the most inexpensive, the least inexpensive it will be. But they say life insurance is expensive. That's not true. You don't need coverage if you're young and healthy. I hear a lot all the time. I've come across a lot of young people all the time saying, oh, I got plenty of time ahead of me. I don't have to put in extra money to pay for life insurance. I'm young, I'm healthy, I'm vibrant, I'm strong. And so they figure I would have to be old and to be sickly to say, oh, okay, I need to start getting into life insurance. And they figure, okay, well, I need to be old, but that's not the case. Being young is the best time to even consider life insurance because it's not having to pay, you don't have to pay as much there. The third one, the third myth, insurance companies won't pay you when you have health issues. That's not true as well. You don't need, you don't need it if you're single without dependents. You definitely would need it for sure. And life insurance provided by the employer is enough. And that's another, I will say, most important myth there at the bottom. For those who have your jobs, as long as you're employed, you're covered. You are considered a responsibility. You are considered a liability to the job. So yes, as long as you're employed, they're going to cover you. But when you leave the employer, you change careers and go somewhere else, you're no longer covered through life insurance. All right, we're going to cover the 4 basic types of life insurance, the absolute basics of life insurance. We're going to talk about the final expense policy. All right, we're going to talk about term life insurance. We'll be talking about whole life insurance, and we'll be discussing the IUL life insurance there as well. Final expense. What is the final expense? What does that really mean when we talk about the final expense? Simply put, it is used to cover the cost of the funeral. That's your last final expense, as long as you're here on this earth. It takes the financial burden off the family to bury the deceased. Okay, you have policies that are usually $20,000 and under, making it affordable. Remember the old myth saying, oh, life insurance is too expensive. No, it's totally affordable, and it actually can be lower than that. The standard funeral and burial cost is $10,000. Okay, now that of course doesn't include casket, limousine service, the dove release, and all those different things that will memorialize you according to the service. All right. Final expense, as well as it does not provide financial support to the surviving family after a funeral. And it does not support family. It only supports you, basically making sure that you're taken care of, make sure you're buried, cremated, memorialized. That's exactly where the expenses go to, and that's the reason for the final expense. You have term insurance, okay, full coverage with a policy which has an expiration date. Okay, so with term insurance, it serves as protection for a certain amount of time. You have a minimum of 10 years. You have 15 years, 20 years, 30 years worth of coverage. It will cover you for that certain amount of time. It is used as a safety net for large liabilities, such as mortgage, auto loans, and different other expenses, emergencies, things of that nature. That term is in place to be able to fund those type of things. And then also term insurance is affordable coverage. Think of it this way. Term is like renting an apartment. Okay, you get you a condo or a house. When you're renting for that specific amount of time. You may have a 6-month lease. You may have a 12-month lease up to a year, right? And after that year, after that time has been spent in that term, then you will be up for renewal. Either you want to renew your lease and start over again, or say, you know what, me and my family plan to relocate elsewhere. Same thing with this term insurance, is that the term insurance is only for a certain set amount of time. Just like a president or politician. President typically serves 1 or 2 terms. 1 term equals 4 years. Well, that term, that time frame, he would preside as a president for that 4-year time. He does well, he gets voted in for a 2nd term. Okay, he's able to be in office for another 4 years. 4 years is that certain set amount of time. And that's why it's called term insurance. Whole life. Whole life is a permanent policy. Consider it to be a forever policy. This is what it does. It covers you basically for the duration of your life. Okay, you have the final expense policy. You have guaranteed premiums, which is payments that are, of course, guaranteed to be paid. We have confirmed cash value. This is money which is there for you to be used. And cash value is a very good benefit to have a part of the whole life policy that covers you for life. And it would also be called a return on premium. So just in case if you need some money that you've been putting in, all those premium payments you've been paying over the years, over the course of time, a greater portion of your monthly premium is going towards the cost of insurance. And a smaller portion will go towards the, let me make sure I get it right. The larger portion goes towards the cash value. The smaller portion goes towards the cost of insurance to make sure that the coverage is taken care of. All right, so you have confirmed cash value. It is extremely conservative, absolutely no flexibility there as well. And what that means is for extremely conservative, absolutely no flexibility, you have a death benefit. Let's say the death benefit as an example is a minimum of $100,000. Okay, so you have $100,000. All right, now in this situation, in this $100,000 policy, you have it for the next, say, 5 years. Okay, you're 5 years in having this whole life policy. And you say, okay, I want to increase 100,000. I'm, making a little bit more money. I can afford to pay, the higher cost of insurance. Okay, but I want to increase my 100,000. My family's getting bigger. I'm having more debts to income to make sure. I want to make sure my insurability needs are covered. You cannot increase it because the moment you sign the initial contract or the initial application on the policy, that 100,000 remains the same throughout the duration of the policy. Now, in order for you to get more insurance, you just have to reapply again. You have to apply more. So specifically for whole life, there's no flexibility in the death benefit, and there's no flexibility in the premiums that you pay every single month. Then also you have the cash value is tax deferred. The beautiful thing is with that is when you're getting money out of your cash value, you're not having to pay any taxes. That, which is a great thing, is considered tax-free. Okay. The next one we have is the IUL, which stands for Index Universal Life. This also is a permanent policy as well, just like the whole life. It covers you for the whole duration of your life, the rest of your life, which is a great thing, right? This is where you're becoming an owner. I want to go back real quick just before I dive into the IUL. So with the term, remember, term is like renting, only for a certain amount of time. 10 years, you have the coverage for 10 years. Once you come up towards the end of your 10 years, that's it. Either you renew or you can leave it alone and just move on to another different policy. That's term. Now, permanent is where you have full ownership of your permanent policy, which means you can have that coverage for the rest of your life until you pass away, basically. All right. So the whole life policy is a permanent policy. And now the IUL also, that's another permanent policy that covers you. And as you can see, it says guaranteed, since coverage is until the age of 120 years old. So you could be 120 years old, still having this policy. Now, after that age of 120, and you have $1 million some odd dollar policy, the company has the right to release that 100 or that $1 million policy to you. Hey, you won the lottery at 120 years old. But anyway, but you're covered all the way up to 120 years old. That just shows you the length of the IUL. It is extremely flexible. The death benefit, your payments, which is your monthly premiums, your investments, it are extremely flexible. Now, remember, we were talking about the whole life. You cannot increase to 100,000. Once you sign on and say, hey, I want it 150, it's going to be 150,000 for the duration of your life. There's no flexibility in terms to increasing the death benefit. But for the whole life, this is where you can increase the death benefit and decrease the death benefit. So you have 200,000. Okay, you come up on hard times and you say, okay, I'm looking at my budget here and I'm realizing I cannot afford this $200,000 policy. Can I decrease the coverage? Can I decrease the cost of insurance? You can do that. You're not stuck at just 200,000 for the remainder of the policy. Same way with your premium, your monthly payments. If you are paying too much and you say, hey, I need to decrease my amount that I'm paying every single month, you can decrease your amount as well. Increase, decrease, you have that liberty to do that. Be your own bank. You can be your own infinite banking. So perhaps if you needed money out of your cash value, you can actually get some money out of your cash value by two ways of either you withdrawing it or you can get it out as a loan as well. Now, I definitely would love to answer any of your questions regarding that, the specifics of that. Tax-free retirement planning as well. You can structure this policy into becoming an income for retirement. You reach age 59 and a half, that's the typical age for those who are looking to retire. When it's time to retire, you're going to still need to live. You still need to have some income. So for those who have Social Security, those who have TSP, those who have TRS, the Teachers Retirement System, right? Those incomes that are coming into from those specific pension plans may not be enough. But with the tax-free retirement plan, the income you get from your IUL can be able to solve that gap, which allows you to have multiple streams of income versus only living off of one stream of income. All right, fourth bullet point, cash value has no income capital gains tax, which means it is tax-free. So whenever you're taking money out of your plan, out of your cash value, say, hey, I need to use this to whatever, get a car, down payment on a house, whatever intended purposes this may be, you can actually use that for whatever. You don't pay taxes on that. That's the beautiful thing. You don't owe the IRS a dime. So that's the beautiful thing of that as well. All right. So the benefits of insurance here. What does life insurance do for you? Okay. There's this beautiful flower here, these different variations here that says it can provide tax benefits, which means you don't pay taxes. It provides peace of mind. You can sleep good at night knowing that, hey, my family's covered, I'm protected. Even your loved ones, those who you appoint as your primary beneficiary or contingent beneficiary, they can sleep well at night knowing that should you pass away, if you're no longer here on earth, they know, hey, we're covered. We have this X amount of dollars that are covering my family. We don't have to worry about trying to scrape change and have to go to GoFundMe or to have to do car washes or have to sell chicken dinners and whatnot just to raise money to bury you and to memorialize you. You can sleep good at night. That's one of the most important things. Provides peace of mind. It covers debts and losses. Should you have a mortgage, trying to pay for college for your son or daughter or grandchildren, if you have a need for emergencies, even medical situations, it covers all of those situations, debt and losses. And that's what they say the IUL, even what whole life does. It's just a blanket covered umbrella over those situations. It provides income replacement. Like I mentioned earlier, if you don't have enough income coming in from retirement, you have it's called a LIBR. That's an acronym for Lifetime Income Benefit Rider. You could turn that switch on and say, hey, I would like to have some lifetime income from my permanent policy as well. So you have pension maximization, you have living benefits that applies to term, whole, and IUL. We'll definitely cover that as well. Tax-free retirement, college savings, policy consolidation, mortgage protection, retirement protection, income replacement, final expenses. It covers it so much. It covers it all. This what we call it, a Swiss Army knife. It has all the different components on that one Army knife with the IUL. Okay, with tax-free retirements. All right, you have the IRS loopholes. You can avoid paying taxes by borrowing. I stress the tax part. I'm kind of circling back on that part, but you don't owe them a dime. This is how it works. When you're investing in or when you are enrolling into a life insurance plan, when you're making payments into your policy, paying into your cash value, paying into your cost of insurance, the funds are coming from your bank, which is considered to be post-tax dollars, which means that you've already paid taxes to the IRS when that money was directly deposited into your account in your bank. So all bank funds are tax dollars. So when you're making your monthly payment into your post-tax life insurance plan, you're just going from post-tax from the bank to post-tax life insurance. Now, when it's time to pull money out of your cash value for the sake of using the money, borrowing it, as a way of withdrawal, you do not pay taxes to the IRS twice. You only have paid it once from years before, months before. It's already done. They don't need you having to pay taxes twice. So when you take funds out, hey, you don't have to worry about paying those taxes. And what happens to the tax rate as we go further on in our years? It goes up. So you don't have to worry about that part. That's the beautiful thing. Loan to yourself, be your own banking. You have cash value that continues to grow, and it accumulates cash risk-free. It participates in the market, but you don't have to worry about losing funds, perhaps if the market drops. College savings. Once again, if you need college savings or if you need money from your cash value, 100% tax-free. I'm saying that again. You're going to hear tax-free throughout the whole duration of this session. It's tax-free, y'all. Take advantage of it. All right. It's not regulated by the state. It's not considered an asset by FAFSA. You can use it for anything versus a college 529 plan that has restrictions. Now, a college 529 plan, for those who decide to invest in a college 529 plan, there's restrictions in that college 529 plan. So how that works is this: money that is saved into a 529 plan, it has to be spent specifically on college, anything regarding college, whether it's books, whether it's a class, paying for tuition, for units, whatever the case is, it has to be related to college. If it is spent on anything else, to buy some pants or a shirt or to buy a new iPhone, whatever it is, you have to actually report that. And when you're reporting that, you're going to get penalized because it has nothing to do with college. So a 529 plan, it does have restrictions that you only have to spend only on college as well. So with the college savings in your IUL, you do not have to spend that on just only college things. You can spend it on a whole bunch of other things as well. All right, you have compounding interest, interest on top of interest. Interest continues to build up on top of, along with your principal. That's how the interest matches your principal that you have that there. And then also you have the option for, it's called minimum death benefit max cash value, which gives you a higher cash potential. So as you're putting money away every single month, going into a permanent plan, such as your whole life, or such as your IUL, primarily IUL, you can set it up to minimum death benefit max cash value. You want it to be solely focused on cash value, to maximize the cash value, to get more into your cash value, paying a little bit less on the cost of insurance, but more into the cash value as well. And that's the benefit of the college savings. Living benefits, living benefits, living benefits. This is, I would say, the second biggest piece after the cash value. All right. Now, living benefits is insurance that you don't have to die to use. So living benefits says that even while you're still alive, okay, you can actually use a portion of the death benefit to take care of your medical needs, your situation. So you can see the puzzle piece here. All right. If you die too soon, okay, of course, you have the death benefit that covers your family. If you become ill, the death benefit will be able to take care of your medical costs. If you live too long, of course, you have the cash value to take care of your needs while you're alive. Terminal illness, chronic illness, critical illness, and also critical injury is what the death benefit covers as well. Now, just real briefly, didn't mean to jump too far ahead. With those different ailments there, you have your terminal illness, you have your chronic illness, you have your critical injury, those situations. With the terminal illness, if you, in case we become terminal ill, God forbid that happens, and the doctor says that you're only expected to live no longer than 2 years, right? If you're expected to expire within that 2-year time span in 24 months, and the doctor certifies that, then that will make you eligible to apply or to file for your living benefits for terminal. So based on the sickness, whether it's cancer, stroke, or heart attack, if you're expected to expire, you can get up to that 100,000, that 200,000. They can accelerate that to you even while you're alive. Okay, chronic illness, if you had trouble performing 2 out of the 6 living daily activities. Okay, if you cannot dress yourself, you cannot eat, bathe, toileting, if it's consonants, talking, or moving around, just 2 out of the 6. If you can't do just 2 out of the 6, okay, you can also apply also for the living benefit, and they can give you paid on a monthly basis out of your death benefit. That's only if you are considered eligible and it's consented by the doctor. The doctor says this is basically certified that you cannot function in these 90 days, 2 out of the 6. You can get access to your death benefit as well. Once again, while you're still living. Critical injury, if it's an injury situation that took place, right, and you had an injury that's, external injury, such as cuts, burns, lacerations, things of that nature on the outside, right? And the doctor says, okay, yeah, we certified this, we're writing this out. Okay, we need to make sure you are being covered medically through your living benefits. You can apply and you have a great chance to become eligible for that living benefit in case if that happens for critical injury. And then you have critical illness, cancer, stroke, heart attack, anything that's in the internal parts of your body, right? And the doctor sees that situation. The doctor can certify that, and they say, okay, she has cancer, she has, or has had a stroke, suffered a stroke. Okay, there's different categories based on your stroke circumstance or your heart attack circumstance or cancer circumstance. Doctor certifies that, turns an international life group. They take a look at it. They say, okay, this is either moderate, severe, or life-threatening. If it's a life-threatening situation, this person needs a surgical procedure and it costs $95,000. National Life Group, again, can accelerate a portion of that death benefit to you while you are living. That's why it's called living benefits. And that's the importance of having this life insurance policy, such as the IUL. because it's also, and the term as well, both of those serve as a way of death benefit and a living benefit while you're alive as well. So you don't have to wait till you pass away, because when you're gone, you don't enjoy none of that money. You don't see a dime of that. It goes to your heirs, right? Your beneficiaries. But even while you're alive and you needed access to your funds, I have clients who have been applying for the living benefits, and thank goodness, they were able to qualify for that. They were able to get access to their death benefit. Another common question I get all the time is, okay, if I apply for this living benefit, right? If I apply for this living benefit, will it shut down my life insurance? Will it shut down me having access to my life insurance? Do I have to apply again? No, that's not necessarily true. So it depends on what's left on the death benefit. If there's some money left over to take care of you, to cover you, and to protect mainly your family, then you can still also proceed on with having the coverage in your life insurance there as well. So those are the benefits and the differences between term and also the permanent. And I say this again, term is only for a certain amount of time. It's covering you for a certain amount of time, 10 years, 15 years, 20 years, 30 years, right? And then you have to renew for that set amount of time for term. Then you have permanent. Permanent is where it covers you for life. You have full ownership of the life insurance policy. You build equity, you build interest, you build value in your cash value, which covers you for life. You also have living and death benefit, which covers term and perm. You have the living benefit and you have the death benefit as well. And so that's the components, and that's just the way how life insurance. Contact us. This is our contact information here. As you can see, my name is there as your facilitator, Renix Graham. That is my email address. If you have a question, be sure to send it my way. We'd be glad to review or do an analysis to see what you will qualify for. We do estimations for free. We'll say we'll just do an estimation for free, a quote for free, to see how much you will qualify for. If you need to set an appointment on our calendar, you can go to the Calendly link. My Calendly link is there as well. You can definitely set an appointment where we can sit down with you as well. Or you can visit our website, www.willwaycec.org. And so you can, those are just different ways and avenues in terms to how you can contact us as well. We'd love to hear from you. If you definitely would want to give your feedback, definitely shoot us a message, send me an email, visit the website, and contact us. We'd be glad to answer your questions or take the survey in terms to what value you received out of this session as well. But other than that, Mr. McCowan, thank you very much for this opportunity. Thank you for allowing me to be of service. And it is right back over to you.
Oh, no, I can't let you go that quick, because I got a couple of questions and I think they would be beneficial
Yes,
from two perspectives. As a new employee, as a new person that's in the field, going into my career field, I just graduated from high school. I just graduated from college. What are some recommended steps that we should take to prepare for our future in regards to term and the different plans that you have to offer? Should I go ahead on and get life insurance at 22, fresh and dressed, out of college, clean, a little bit of dirt behind my ears? I go and try to get an IUL. If I'm just hitting the market, what are some steps that I can begin to take now? Because they're telling me about 501k. They tell me that it's good to start a 501k. What are some steps in regards to life insurance that I should take then at that age? And then I have another question.
Yeah, no problem. No problem. First step for sure is budgeting, just to sit down, do your own analysis, write out and say, okay, this is what I'm paying on bills or my dorm rent or whatever the case is, gas, just all of your daily cost of living. Then you're asking yourself, okay, life insurance. If anything happens to me while I'm young, God forbid, but things happen, right? If anything happens to me, what will my family have? What will my family have set aside to bury me, or something happened? I hit by a car, whatever the case is, right? And you say, okay, you know what? I realized I shouldn't have to rely on somebody else's funds to make sure that I'm taken care of. What can I do for myself? And so when you're doing your own budgeting analysis and you see, okay, you know what, I have $50 set aside, $80 set aside. I have some extra money, some discretionary money that's set aside. Maybe I should consider putting that towards a permanent policy. And I would say a permanent policy while you're young, because it's cheaper, it's much inexpensive. So the younger you start, the older you get, that cost of insurance doesn't even go up. So, 22 years old, right? And I'm just saying, hypothetically, you pay $100. We pay $100 every month for life insurance. So you have a $150,000 coverage. And the benefit of that is this: every month I'm paying $100 going into my permanent policy. $75 of that 100 goes to my cash value. $25 of that goes to my cost of insurance. Now with that 75 to the cash value, you're building some equity there. So after 10 years, 11 years, 12 years, you realize, okay, you know what? My old car, my putt is broke down. I need about $4,000 for a down payment, $3,000, whatever the case is. Hey, how much I have in my cash value? You can always go to your cash value and realize, okay, hey, I got some money here. I can always, be able to pull out. And here's the second part about it too. Going back to the cost of insurance, you're paying $100. As you get older, going from 22 to 32 to 42 to 52 to 62, 72, 82, right? Let's say you're in your 60s. If you had not paid or even considered enrolling in life insurance at 62 years old, the older you get, guess what happens to the cost of insurance when you decide to want to do a quote? Let me see how much I will have to pay. You're looking at close to $400, $500, $600 a month to have to pay for life insurance because you didn't apply for it while you were younger. So at age 22, you're at 100 years old. You're at $100 a month. When you're at 62 years old, you're still paying $100 a month. And in fact, to tell you the truth, after 30 years of putting into the policy, paying $100 a month, you're done, you're finished, because the cost of insurance is satisfied. But when you go around and you're in your 50s and you hear some friends or whoever that's working at a job and say, hey, I need to get some life insurance, but I'm talking to these different agents to get quotes, and I'm looking at the quote statements I'm paying, they telling me $500. Well, Mr. McCown, how much you paying? Oh, I'm only paying $100. $100? How? Why are you paying so little? Well, because when I was 22, going back to college, I started early. And when you start early, the lower the age, the lower the cost of insurance. The older the age, the higher the cost of insurance there. But starting young, my recommendation is to just do a budget analysis, sit down and do an assessment to say, hey, here's what I'm paying on bills. I have some discretionary leftover money. Okay, what must I do with that? Okay, I definitely must consider permanent life insurance versus term. Term, you're only paying for coverage, only for coverage, but you're not putting into no cash value. There's no return on premiums. You can't get any money back out of a term. We're only just paying for the term policy. But hopefully that answered your question.
Yeah, so and it's good because oftentimes we take it for granted that we're going to live, and that's a whole nother subject. But right. starting early on everything, I'm getting life insurance, whether it's a term or what's the other term that you give us?
Permanent. Mm-hmm.
Permanent. They got term, temporary or permanent. Whether either one, it's important to do it, but you recommend that we do the permanent because it gives us something that doesn't time out. Right. Exactly. Like your car insurance, you got to pay your car insurance, and whether you use it or not, you lose it. You don't get anything from it. It's not permanent. It's temporary. It's just a term. But permanent, invest in yourself, and then you can use those funds in other areas as you see fit and as you need. So I think that's important for those who may be younger, who may say, I got time to wait. So on that, and this may be another one of your workshops, but if you can answer it, having multiple streams, this permanent life insurance can also be a part of our our multiple streams of income that we have that will help us set us up for later. It's never too early to start preparing for your later. So,
Right.
all right, so that'll help us with that. All right, I'm not going to teach your class, but this
You good. You got it. Yeah, I love it.
If I had known this when I was in my 20s,
Mhm.
after graduating from college, things will be a little bit different. I got it a little bit later, but I'm grateful that I finally got it and I understand it. So I want to encourage you, if you're in your 20s, you just got out of college, fresh out of college, and you're trying to get yourself established, before you go buy a new car, before you go do anything, you need to set up for your future, because in this up and down environment, it's important for you to set up. Now, getting out of from the young perspective, now transferring to as a pastor. Many churches, many pastors of churches are dual career, bivocational people, multivocational, because it's just not by myself. I don't have two jobs. I have more than just two jobs. Pastor, engineer, other little things that I do, a business owner. And so we have churches and pastors who are laboring in the church but don't have insurance. How should I, as a pastor, encourage the church, or what are steps I should take as a church or as a pastor to make sure that we have the insurance that we need for ourselves, considering that we serve in ministry? Does that make sense? I don't know if I'm...
Yeah, no, that makes sense.
And what are the easy ways to do that? Because oftentimes we think it's difficult. And we just started ours. If I may ask, how long did you start ours? It was like 3 years ago? 3 or 4 years ago, right?
In this field, about 8 years ago.
No. My IUL. When did we
start? Oh, yours.
That?
Yeah. Yours is about 4 years. Okay. 3-4 years.
So initially I thought that it was very expensive. I was like, no, we can't afford it. No, we can't afford it. No, we can't afford it. But then when you laid it out to us, it was something that the church was able to afford. So it's important. So what should churches do, or what steps should churches take to be able to cover their pastors via insurance? Because as much labor as we put in, work that is put in, it's very important that the church sets up something to be able to take care of their pastors. What are the steps to be able to get that going for a pastor?
Yeah. I would definitely will be the same thing, like that college student is doing an assessment, but in this situation, because being a pastor, over, your church is going to consist of more than one person. So now you want to get together with your trusted board members, or those who you love and trust, even say your first family, sit down and say, okay, hey, by me being a pastor, the work and labor that I do, I want to make sure that, my church is taken care of, to make sure those who I love is covered. Should something happen to me, by way of health, God forbid, but in case something happens, no other ministry or no other person outside of the circle of the church can get in and make changes and figure, I need to get some of this money. No. Your crew, they say your board, those who you trust, they'll get together and they say, okay, you know what, we're going to cover you, Pastor. We'll put in, what they say, they'll have some type of ministry fund, church fund, or whichever the case is, it'll be, covering the pastor. Now, to say the pastor can be considered the insured, the church can be the owner of the policy, vice versa. The church can be there insured, the pastor can be the owner. But mainly, I know we're looking at how can we make sure that the pastor's covered, so that way something happens to the pastor, it's not going to be a big financially hit to the church, where the pastor can be the actual insured, the actual church can be the owner. And so by the church being able to fund the life insurance policy, that will be able to make sure, that the pastor is covered. And, and then in terms to how much, that's another question that I would get from my clients. They say, okay, well, I'm not sure how much should I be covered? How much should the church be covered? say for me, say if I was a pastor, not a pastor, but as an example, it's not even for me, it's for y'all. Make sure that y'all are covered, make sure y'all are protected, right? Because when I leave and I'm going to glory, I ain't think about y'all. I'm gone with God. But for those who are still remaining, we figure, okay, how much can we cover the church? And so this is what I would do as well. We would do what's called a dime analysis, DIME. That's an acronym for, you got debt, you got income, mortgage, and let's say education for the E. So you say, okay, the debt, how much debt is the church paying? Okay, we'll figure out, okay, debt is, as far as what the church is paying annually, 100,000, let's say that, right? Okay, what is the income? What income is the church getting based on the contributions to the, just for the ministry? Okay, we're averaging 200,000. I'm just throwing numbers out there. All right. Mortgage or rent. How much is the mortgage? How much mortgage is the church paying, or how much rent is the church paying every year? Paying, 40 to 50,000 a year. Right. And then you got E for education. It don't have to be like education, but it could be for whatever the case is. Right. You're just tallying up all of your like your debts. It's called debt to income ratio. That's where you would determine your insurability needs. So you say, okay, we have a total of $450,000 that we would need to make sure that the church is covered. Because if something happens to me and, a certain income stop, the church has to continue to keep going on. So we see, okay, 450,000. Okay, great. So we'll tack on an additional, let's just say another 100,000 just for cushion and leverage. So say we'll increase that to 550,000. So the church would need total 550,000. So should something happen to me, my beneficiaries is my spouse or son, whoever that's on that board of trustees, will be covered as well. So when it comes to the church or any like establishment or say company or entity, now you're no longer solo. Now it's more multiple people involved. This is where you sit down and just do a financial analysis to see, can we afford this type of coverage to take care of the coverage of the church.
Now, and this is my last question, just for clarification. And so it is more recommended, instead of getting a term, to get a permanent insurance policy. Now the term is going to be less expensive than the permanent, but the permanent is something that you actually have access to the extra that you end up putting in. So for example, if the term insurance, the general term life insurance costs $25, it's the same $25. You may be paying $100 in the permanent, but you're collecting that $75 and it's just stored up for you later. So term, you're paying $25. Permanent, you're paying $100. You're still paying the same $25, but you get to keep the $75 and use it later on. That's as simplistically as it can be said, correct?
I want to ask you, are you sure you're not a life insurance agent yourself?
Oh,
you
man,
got it.
I paid attention and I learned. Okay.
Yes, you
Come
got
on,
it.
y'all.
Absolutely.
It's just that simple. It is imperative that we prepare for our future, and not just for our future, but the future of those that are connected to us as well. And having life insurance is imperative in the communities of color. And you must know, and you've got to know that it's deficient, it's inadequate, it's insufficient. All of those words I just gave you, in our communities, we don't have life insurance. So when our children die, our parents die, our siblings die, most are not even prepared to be able to have something that will cover them in case of their death. And then they also don't have anything to leave behind for those that they leave behind. We can do a better job in preparing for our time that's going to come. And we can do that so that we can be an asset to our families and not something that takes away from our families during our death. And I don't know, it hasn't happened to us recently, but having to do a GoFundMe or do anything like that, I don't know how often they raise enough funds for the thing, but too many of our families are in debt trying to bury someone who did not just take a simple moment to set aside a couple of funds, stop going to Starbucks for once a week and That'll give you $25. Stop going out to eat one day. That'll give you, some money to be able to put aside that can be an asset. All right. So I would like to thank you, Brother
Mr.
Graham,
McCown,
Mr. Graham.
if I can jump in, one thing about that.
Yes, sir.
And I wholeheartedly agree with you in support of what you're saying about GoFundMe. I make this clear, and it's not to offend nobody, but I tell y'all, GoFundMe is not a legacy. GoFundMe is not a legacy. Car washes, chicken dinners, having to, do fundraisers, those are not legacies. And having to see that where your family is having to labor and to work and to do more work just to make sure they put you in a plot is totally not a legacy. So definitely consider life insurance. When you say GoFundMe, that's just another thing too, because basically what GoFundMe is saying is, can y'all please help fund my irresponsibilities? Can y'all help fund my poor choices I've made in the past? That's what GoFundMe basically is saying. And again, it's no knock to it. Thank God for it. It's been a great help and a great tool, but that should not have to be the last resort for us to fall back on. That shouldn't have to be the last thing we have to go, bother other people's bank accounts, have to dip in their pockets just to make sure that your family is taken care of. That was just a very important piece. And that struck me when you said GoFundMe. I'm like, I got to get this out. But y'all, listen, GoFundMe is not a legacy. But having something where your family can be able to benefit from and be able to have the benefits from, such as a term and a perm policy, that is a legacy that you leave for your family. Okay, I'm done. I'm finished.
And that's good. And I think it's important. I'm a pastor, for those that don't know, and Proverbs 29:18 tells us where there is no vision, the people perish. And what happens is where there is no knowledge, no information, the people perish. All of these tools are out there. The issue is that our people don't know. They don't know the little tricks and the trades and the little tips that other people use to get ahead. And so we're trying to equip our community to be more effective and more powerful with their money. Our money has power. And Brother Graham, I think that we got to keep expanding upon this one. This is our third month of sessions. We've had 5 pillars of financial strength. We've had workshops on retirement readiness. And then today we're having life insurance. I'm going to ask you to come back next month. I know we had a former schedule, but I'm adjusting the schedule. I want you to do a recap of those 3 workshops you've done next month on the second Saturday of next month, to just do a recap. So if
absolutely,
you can do a recap of those 3 to give people nuggets, just in case they have not done it. And then we're going to start this cycle back over again in November, and start the cycle back over again with the 5 pillars to be able to do that, to be able to help those that did not get it. Again, these videos will be featured and posted. If they're not there yet, they'll be posted on our YouTube channel. You also can find them on our Facebook Live page. Mr. Graham, do you have anything else before we dismiss, before we let the people go?
We're good. We're good. I highly recommend just consider coverage, sit down with your family, talk to your people, to those who you love, those who you really, really love. Talk with them about the importance of life insurance for sure. But glad to be here, glad to be a part of this program. And life insurance is important. And the word I want to leave us with is little becomes much. You start off with little, and the earlier you start, it becomes much. Yes, sir. But you got to start with something, and you don't want to have much and return little, because if you, the older you get, it costs more just to get less. And so when you're younger, you can get more with less. And so let me not get him started, because that's a message. Yes, sir. Undercover preacher, brother. Mr. Graham is an undercover preacher, but we thank you for joining us. We thank you for joining us today. And we hope and pray that something was said or done that encouraged you, that empowered you, that strengthened you in regards to being more literate with your finances. We have so much money, so much power, financial strength in our communities. We just need to learn how to invest them more efficiently and properly, that they can work for us instead of working against us. And so we hope and pray that you've been encouraged. I want to encourage you to go by WeServeVA. That's WeServeVA.org. You see it on the screen, and you can see our calendar of events, our activities. We have our initiative called WeCARE. That's WeSerVE Cares, or short for WeCARE.
WeCARE is short for WeSERVE Cares. And we're trying to do everything we can to empower our communities, and not just those that are in the town of Dumfries, Virginia, but we're trying to reach people throughout the nation. And so if you were encouraged, you were empowered, leave us a message, leave us a note, and let us know how this helped you and how these activities are helping you so that we can better serve our community. We pray that you all will have a wonderful and blessed day, and tune in next month for our recaps and our reviews, where we'll continue to have employment readiness, personal development workshops, and financial literacy workshops. We'll have our recaps next month. We also plan to have on September 30th, our Kingdom Men, a nonprofit that's attached to Praise Center Church and We Serve, Kingdom Men DMV, will host their first Standing in the Gap conference on September 30th. That's the last Saturday of the month. We want to encourage you to join us there. It's free. It will be in person. And then next month, I believe it's on the second Saturday of October, we will have a health clinic here at Praise Center Church in conjunction with WeServe Community Development Center Corporation, and also Will Way Community Enrichment Corporation. We're teaming together to provide health information for our community. Blood pressure, hopefully flu shots. We're working to make sure that we provide a one-stop shop where you can get all of your health questions and needs met here in this area. Have a wonderful day. We look forward to joining you next month. Bye-bye.